let's get started and welcome everybody to the daily energy markets commentary, where we take a moment each morning to review how the energy markets have opened in Asia and how they're likely to impact the Middle East and the European trading day. Today, Monday, of course, the first day of the trading week, although here in the Middle East we've been busy at it since Sunday. I just brought up, for starters, the latest update on our Twitter poll regarding what the expectation of the difference between the supply and demand gap might be by the end of the first quarter. That seems to be, amongst the many things floating out there, one of the biggest sort of issues of debate. And as you can see, as posted on the page, that supply will exceed demand by 10 million barrels a day is just pipping ever so slightly by 5 million barrels a day. So that's probably pretty good for prices if the expectation amongst the 60 odd people that voted in this poll is that that the gap will have shrunk that dramatically, having been generally acknowledged to be about 30 million barrels a day in April. So maybe that's one of the reasons why we saw such a run up in prices last week. Anyway, that's some context for our conversation this morning. I'm going to kick off with one of our new speakers who haven't joined us before, and welcome Kevin Wright, lead analyst of APAC for Kpler, and I believe recently joined Kpler, based out of Singapore. So Kevin, welcome. Deep history you have in experience in physical and paper oil markets. And so now you've taken a nice retired position in the analysis game and no longer putting your life on the line every day.
It's a little different, yes.
Well, welcome to the other side of the street in that respect. What's your sense of this survey question we started with, and how do you see the rally last week and the outlook for this week?
Yeah, I think it's a very interesting question, because obviously if you look at the situation right now, we've got supply over demand by something like the 20, i.e. the first option that you've got within the survey there. I think as economies start to open up, and obviously a lot of the major economies in Europe are starting to open up really today to a varying extent, we will start to see a recovery in demand, and therefore, it's going to be a natural progression towards, I'm not going to say balance, because I think it's far too early to say balance, but it's going to be a natural progression to a more balanced situation than we have at the moment. Are we going to see it at 10 million barrels? I personally am skeptical about that. I think that's a very bullish scenario, and I think therefore the impact on price from that sort of move, from that sort of recovery or correction, is over optimistic. I think probably something around the 15 to 10 range is where I think things are likely to be by the end of June, by the end of this quarter. But I think much more than that really is over optimistic. I think it's a little bit too...
OPEC had in their initial OPEC plus, the 20 odd countries that put together the deal for cutting supply from May 1st, had only put the big bazooka 9.7 million barrel a day cut just for 2 months, because they did forecast that the closure of that gap would be significant enough to allow them to increase supply again in the second quarter, or the third quarter, from July. Would you be expressing some caution for that?
Yes, I would. You've got to bear in mind something that's very important, and that's that Saudi exports in April were the highest on record. There were 9.55 million barrels a day. So to sort of put that into the context of the cut, yes, May to date we've seen just below 8 million barrels a day, so 2 million of reduction from Saudi itself. But given that, I think you've got to sort of bear in mind where we've come from and where we are now. If you set your benchmark based on a number that was already elevated, then how valid is your new benchmark? It calls into question the possibility really for a true 9.7 million barrel cut for the next 2 months, including May, when really that actually might be a smaller cut than actually is really being expressed.
Let's bring in our second speaker, also joining us for the first time, but very familiar to Gulf Intelligence, Tony Quinn, CEO of Tank Bank International, well known in the storage business with investments in Fujairah and Singapore. Tony, thank you for joining us. You're no better place than anyone to comment on the growing skepticism around that the sort of demand destruction is not as large as it's been initially forecast, the 20 to 30 million. Just look at storage, it's not full, although perhaps maybe booked, but US storage is in the 60% range, etc. What's your view on the outlook at the moment?
Thanks very much, Sean, and thanks everyone. Thanks, GI. Yeah, I sort of, I've always been, as you know, the Irish skeptic in me comes out on a lot of these things, particularly when it comes to the storage. And you mentioned it in your comment there about storage positions. There's still some available, and the only thing that's available, as also you touched on, was really volume that is actually currently contracted, and those that are contracting don't want to release it. And they're doing that for obvious reasons. Maybe it's to keep out competition or whatever. However, what we have seen is that the storage market is balanced now, and it has been for a while. In fact, and this situation is proving that case, where we do have a real demand for physical steel on the ground, and really, in the last 5 years, you would have got it anywhere. Now you can't get it anywhere. And which has been proving my point for many, many years, that you shouldn't be building too much of the steel, because once this market disappears back into its normality, you won't need any of it. So we have an issue, I think, with the way that the market is structured, in that everyone thinks that the storage guys are having great fun when the Contangos are on. If we wait for a Contango, we're a dead company and a dead business. So, and I have terminals in the Caribbean and terminals in Fujairah near you. And those facilities, we make sure that they're strategically contracted. Now, if there's space in there, it's up to those clients to release that space, and they can do that on a third-party basis if they wish, or lease, so long as they have an arrangement with us to do that. So really,
would you say that's forcing more barrels into floating storage than otherwise would be, given the demand at the moment?
Well, floating is a temporary measure in the best of times, because one, it's a low cost option because it's short term. So you can rent a floater for half a month. You can't do that with a storage facility unless you have a very bad storage facility that doesn't have anything in it. So really, the floating position is always literally going to be just that. It's going to be sailing. It's not so easy to blend. It's not so easy to move around. It's not so easy to get to end business. And it's not strategic. So it's a pure money play, which is why the steel storage on the ground guys don't really want to get too deadly into Contango.
Can I jump in on the floating storage?
Sorry, Kevin, I just want to bring in our third speaker, Adi Imsirovic, Research Associate at Oxford Institute for Energy Studies. Adi's a regular commentator on our program, and welcome back, Adi. One of the things we're seeing, and we have in the digest today, that cars are staging a comeback as commuters avoid public transport as economies reopen. We even had Boris Johnson last night, probably on your television in the UK, telling you not to get on the tube when you go back to work on your construction site today, but to take your car. I'm not quite sure how that works, but nonetheless, that was his recommendation. Kevin, You wanted to jump in there ahead of Adi.
Yeah, I just thought Tony raised a very interesting question about floating storage. I mean, obviously, Kpler's bread and butter is looking at movements of vessels, looking at inventories and so on. And I think the story around floating storage is really one that, it really captures what's happening out there right now. We've got Contango in the crude market, we've got Contango in the gas oil market, and obviously everyone wants to take advantage of that. Now, as Tony rightly says, even though storage may be available on shore, it's booked, it's contracted, and therefore the owner or the holders of that storage are not going to give it up. So they're looking around for an alternative. And what we've seen, just to give you an idea, total world floating storage on crude currently sitting at 172 million barrels. That's 47% higher than it was a month ago. And if you look at clean products around the world, 86.36 million barrels. And that's 169% higher than it was a month ago. So that really shows
is floating as well, is it?
Sorry, these are all floating. These are just floating.
Right.
And as you know, Kpler has a very clear distinction or definition of what floating storage means. It's a vessel that's moved at less than 1 knot and has been doing so for at least 7 days. And the reason for that, obviously, is if it's under 7 days, it could simply be waiting for a berth, or it could be carrying out some other operations. So we're very clear about how we define that. And as I say, the numbers themselves are stark: 47% on crude and 169% on clean products.
What do you think gave the market such a lift last week? Somewhat unexpected. Most sort of analysts were indicating a decline last week, but nonetheless, the market took off.
It's a very interesting question. I mean, obviously, we've seen prices very depressed for quite a while. I think there's been perhaps some opportunistic trading over the last couple of weeks. People think it's gone too far, and this is really just a short-term recovery. I mean, the interesting thing for me as well is that Brent, just before we came online here, Brent was off by 50 cents today, which says to me that there's some profit taking going on. And I think that's probably on the back of what happened last week. I mean, it's far too soon to say that there's been anything structural that's changed, and therefore that we've got, you know, a long-term recovery in crude. I think what's probably happened is the foot's gone off, you know, the pressure's gone off crude to a little extent, and so people have taken the opportunity to get back in.
Well, two things have happened which are quite significant, one would say, although their impact is more long-term, but their sentiment is immediate. The OPEC cut took effect last week, and a number of U.S. states, including Texas, which is by itself the 10th largest economy in the world, reopened gradually. Adi, are you back there? Do you want to try your audio?
Let's try it. Can you hear me now?
Yeah, perfect, yeah.
I've closed some apps, so
yeah,
okay,
perfect.
hopefully.
We can't see your handsome face, but we'll take your voice.
Okay, thank you very much. Just going back to, it's very hard to disagree with Kevin and Tony. In terms of the rally, it was a bit of a surprise last week. This morning also I saw that UAE announced an increase in official selling prices, and Murban's gone up $2.50, which is quite significant and not surprising either, because we've had a big increase in all the, not just flat price, but the structure. My guess at this stage, it's very hard to tell obviously, but it's to do with the flows. All the oil that's going into storage needs to be hedged, and it's normally hedged by front to backs. So all that big volume of oil has been hedged by selling the back end of the curve, which probably lifted the front end a little bit, plus the news of easing up. That also has probably killed off at this stage, at least the floating storage idea. I think all those who've booked floating storage, they've already hedged up, and the Brent spreads and the Dubai spreads, even at the front end, do not really make much sense in spite of the freight rates falling quite significantly. So it's quite an interesting situation right now, because we are in a bit of an uncharted territory here in terms of demand. There's a lot of pent-up demand out there. I'll tell you something, Sean, my barber is certainly going to be quite busy as soon as we ease off.
He is, yeah, but he'll have to turn around when he cuts your hair, so I'm not sure, he'll have to do it backwards or something. Although Tony won't have that challenge by the looks of things.
But you had a great headline here also with Carnival Cruises. To me, that was unexpected. I think a couple of weeks ago, sending somebody off to a cruise was basically a swear word. Now seeing this demand is just incredible, and it's very hard. I think we've never been here before. How our behavior is going to adjust to this is quite interesting. Some people just go on holiday.
Well, the U.S. consumer loves a bargain, and at $500 for a week cruise around the Caribbean, you probably once in a lifetime opportunity. But it does show that, you know, the right price point will trump fear, I think, in the recovery when you see that. Tony, I just wanted to come back to you on your views with the Contango outlook. You seem to indicate that you weren't very optimistic that it would last very long.
I think it's blurry, because as we saw, you know, a couple of weeks ago, you have this huge roller coaster ride going on, which is sort of now a small roller coaster, which is happening every week because of sentiment and paper trades and so on. I think markets are settling down. And going back to what Kevin said in the beginning, I'm more optimistic about that balanced market because this is actually causing us to rethink the structure of our logistics around the world. And I think it's the time. A lot of people will hate me for saying this. The time we needed to actually understand the value of the storage market, for instance, in our world and what it does, because it was sort of a secret word before that no one knew about. So I sort of see structural balances coming, really due to people really understanding what is happening in the markets here. And we're seeing a little bit of a shuffle of some of the smaller players who can't quite cut it, in the market that have dropped off the edge. I mean, there was one sort of high profile a couple of weeks ago. There was another one just a few days ago here, which is now being under investigation for all sorts of things. So the markets have straightened themselves out. I think the legal system is straightening itself out because they've all got time.
I would have to just interject there and say, from an outside perspective, one would be a little bit surprised that Singapore has had this domino of bankruptcies or negligent performance or whatever you want to call it, given that one would have expected the Singapore regulator to be much more robust, but this would indicate perhaps not. What's your own sense on that?
And I think Kevin will probably support me on this. I mean, we sit in a very, very strict regime when it comes to sort of accounting and auditing here, which doesn't sound good from the Malaysian debacle of a couple of years ago and some of the recent stuff that's going on here in Hinleon and so on. So I'm surprised, but I think if it's happening here and it's being caught here, it's probably happening elsewhere and not being caught. And I think that's the reality. I just wanted to add something. Actually, I can add something a little bit on your Carnival Cruises comment. At our GTI Statia terminal, we actually bunkered 3 of the Carnival cruise ships at the weekend. They were bunkering from Thursday through to weekend there. So they're getting ready. Now, I'm told they're repatriating staff because, of course, these cruises can't technically start until the end of July anyway under the current regulations. But it's interesting that they were bunkering them because they were getting ready, even if it was just to move people about. So we're seeing some flow of bunkers onto cruise ships for that reason.
One of the other reasons why I think oil prices have been given a bounce in the last week and it might hold through this week and the equity markets is the stimulus that has been so significant and is indicated that there may be more stimulus coming out of the US. But in the Saudi Arabia this morning, and I wanted to bring in Frank Kane, the senior columnist for the Arab News, the biggest English language daily newspaper in Saudi Arabia. There's a story just broken out of Saudi Arabia that they're going to triple the VAT in the country from 5 to 15% in one foul swoop. That is a massive hit, and I'm wondering, Frank, your thoughts on that and how that's likely to play out.
Yeah, hi, Sean. Well, this really was an overnight shock, and VAT in particular was a controversial tax that was introduced a couple of years ago. But people didn't like it. It didn't have a very good effect on the economy. Of course, it raised some tax, but it depressed overall levels of consumer spending for some time. So that's a shocker. Also, the cost of living allowance, 1,000 riyals per month for government employees, that's going to be cut from the summer. So, they are back in full austerity mode, it seems to me. I wrote a column last week in Arab News, Sean, where I kind of tongue-in-cheek suggested that economic policymakers, unnamed economic policymakers, should perhaps reread John Maynard Keynes' general theory of employment during the lockdown. Well, if anybody read that column, they certainly ignored it because they've gone exactly the opposite way.
Which is an outlier for the rest of the world. I mean, austerity as a measure at this moment seems to be one that the rest of the world is not following.
That's right, yeah. The only G20 economy to have, chosen austerity rather than stimulus, rather than fiscal stimulus, it seems to me, on balance now. It'll say
one of the things about VAT in the region, Frank, that it was so long planned, but when it finally was delivered, it was based on the fact that all of the economies in the GCC moved in synchronicity together, and to a great extent that happened. Do you expect, or what is your expectations that others will follow with this massive leap?
Yes, I was about to say, I think it's only a matter of time before we see this here in the UAE, where I am. I mean, those are the two main partners here. They tend to move in step together. So I think that's only a matter of time. The other little snippets from the Saudi finance minister's statement, early hours statement, was, as we thought, some delay, some rephasing on the Vision 2030 projects, and also the establishment of a committee to study salaries and benefits in the extra civil service level. And this can only mean, the kind of expatriate consultants and workers who are, getting paid quite handsomely for Vision 2030 related projects. So, all those are signs of austerity. I don't use the word lightly, but I think they sure are,
Well, I suppose the Saudi finance minister did signal that quite clearly last weekend, and here he is a few days later.
He did indeed, but I think the VAT rise, was beyond anybody's expectations.
Yeah.
He also said last night the journey ahead is long. So this may not be the end of it. There may be more cuts to come at the fiscal level.
Well, they certainly will be playing with some possible socioeconomic challenges there, as they had in the 90s if they get too austere. Kevin, let's just come back to the markets as we see it this coming days. Today's Monday. Asia's opened relatively timidly, but nonetheless, it hasn't given up much of its gains from last week. How do you see the coming days trading?
Volatile. I think, it's the classic anecdote, or the classic saying, I should say, of never put your name, the price, and the date on the same piece of paper. And I think right now it's just very difficult to say. I mean, we are moving by dollars a barrel each day, and the direction of it can be driven by something that we may overlook macroeconomically that doesn't seem particularly significant, and then we move less for something that seems maybe more significant. And I think with all of the factors that we've discussed today, the opening up, the potential for, cruises sounds crazy, but the potential for cars to stage a comeback, all of these things, it just creates, or it prolongs the uncertainty. And as I say, putting your name and the price and the date on a piece of paper at the moment is just dangerous, foolhardy almost.
But nonetheless, we have to do it, and
we do.
And some of us have to, not myself, but obviously trading this market at the moment, it does seem very difficult to call. But there does seem to be a floor consolidating, Tony. $30 on Brent seems to be finding some kind of firmness. Maybe I'm speaking to, as Kevin said, don't put a number on a page, but $30 oil does seem, if you take the volatility of the last few months and weeks since this all started, it all seems to come back to $30 Brent each time things settle down. What's your thoughts for this week?
Well, I'm one of those guys that's always been a believer. If your business doesn't work on a $40 Brent, then you shouldn't be in business. So, and I've been saying that ever since it was, 120. So, I've always worked on the basis that if you take the business of oil over the last 100 years and equalize it for currency differences and all the rest of it, the value of 40, 45 is around about where it should sit. So I was always skeptical about some of the American operations coming on and operating at 60, and things like that. Projects here, some of the Malaysian projects here were operating at a $60 barrel. That's the sort of stuff I just saw as being ridiculous at the time, and it's now proven nothing to do with me. It's probably to do with the barbershops opening tomorrow, because that's probably likely to affect the price of oil more than anything else we're going to say. So I think the $30 oil, I've got a bet with my friends at Vitol that it sits at 40 at Christmas, and I did that at Christmas when it was 65. So So let's just see where it ends up. I think $30 oil is at 35 to 40 is the range we should be looking at.
Let's just go to Matt Stanley and come back to Addy for final word. Matt Stanley is also joining us on the call, Director of Star Fuels. I just wanted to get Matt's quick snapshot on his expectations for the week ahead. Matt, your thoughts?
Morning, Sean. Morning, everyone. I agree with Kev. The market is full of mixed signals at the moment. I think to take demand on where storage figures are is wrong. The amount of floating storage that is around and the relatively deep contango we're in, is very important at the moment. But the Saudi thing this morning, I think that is going to be a concern that a lot of people have. But that Saudis also slashed gasoline prices locally in the kingdom by 50%. So I think that there is a change of direction that people are going down. The contango is coming off a little bit this morning. Everything is very well bid. So I think that it's going to be key this week to follow structure. And I think that certain countries' strategy is going to change. And Saudi, I think, are leading the way.
Any immediate comment, Matt, on the OSPs announced over the weekend, the Saudi and Abu Dhabi?
It's an interesting, in order for there to be a pact and for production to really be curbed, these guys need to work together. And that's what they seem to be doing. So there needs to be some clarity and some unity. And I think that we've seen that in the last few days with the OSPs.
Okay, Addy, the last word is with you. Hopefully we'll be able to hear you. Please go ahead.
Just going back to the price, I think that's something we all are looking at. I think the main point is that if compliance, we did some numbers, let's call it back of the envelope numbers. If the compliance stays 100%, we could actually see market balancing and reaching $45, even $50 by the end of the year, which is very unlikely. 100% compliance. The numbers we crunched on about, say, 50% compliance could give us a balanced market sometime middle of next year. So yes, I do agree with Tony. I think we could see balance. Let's call balance market $45, $50 sometime, but at least by the end of next year.
Well, thank you all to our speakers for their comments and insights this morning. We will be joined during tomorrow, or rather on Wednesday, for the halftime talk feature interview this week with Dr. Fatih Birol, who will give us some updates on his demand expectations. He had signaled early in this crisis that April would be the worst month. He was the first one, I think, to call 30 million barrels a day of demand destruction for April, with recovery in May and June. It'd be interesting to see if he still holds to that, and some other insights. So keep an eye out for that on Wednesday. But for now, please keep safe, be economically productive, and we look forward to catching you all tomorrow, same time, same place. Thank you, Kevin. Thank you, Tony. Thank you, Addy and Matt, for jumping in, and Frank for jumping in as well. All the best.
Thank you.